Welcome to the People, Property, Place podcast with me, your host, Matthew Watts, founder and managing director of Rockbourne. This is a podcast where I share the stories, views, opinions and career journeys of the movers, shakers, innovators and leaders in the real estate industry. Welcome to the People, Property, Place podcast. Today I'm joined by Nickolas Blackburn, co-founder at Blue Current Capital. Welcome to the show, Nick.
Hello, thank you. Thanks for having me.
So Blue Current Capital is an ESG-focused real estate investor, developer and operator, enabling and accelerating the electrification of commercial fleets across the UK and Continental Europe. The core focus is to service the requirements of businesses which are rapidly expanding and electrifying their fleets by developing and managing purpose-built EV charging hubs in close proximity to their facilities. We're going to come on to that a little bit later, but a place I always like to start, Nick, is how you got into property in the first place, because you haven't had a really long career by lots of standards. But yeah, how did you get into the space?
Yeah, definitely. So I'm originally from the Lake District, born and raised. I think it was our early days with our father he built and owned a hotel in the Lake District. And me and my brother always very much involved hands-on from day one, construction related works, building parts of the hotel and so on. And I guess that inspired us to get into that industry. So I studied my undergraduate degree at UCL. I did project management for construction, so quite vocational. I did a sandwich year as part of my degree. I worked at EC Harris. It's now known as Arcadis. It was a project management consultancy practice. I worked at Heathrow Airport for the year. It was fun, it was informative, gave me some good experience, but definitely sort of taught me something that I didn't want to do. I wasn't really cut out for consultancy work behind the desk and things like this, but finished the degree, and in my last year I got offered a job at BP as a construction engineer. And I think I didn't expect to work in the oil and gas industry, to be honest, but it kind of came across my desk. The job description was excellent, was to work on major projects, hands-on, boots on the ground kind of stuff, and potential to work globally as well. So that was really exciting. And sort of the week before I was due to start, I was in London, came back from a summer of traveling and whatnot, and then got a nice email saying you're relocating to Aberdeen on Monday, which was unexpected, but it was a exciting challenge. I was a young guy, I thought why not? Moved up to the North Sea, part of some really exciting projects up there. And I loved my time there. It was really, really great experience, really making use of what I thought I wanted to do, working in projects, construction industry, albeit not in the built environment, but in the energy sector. Unfortunately, that period of time, around 2014, also coincided with a huge slowdown in the price of oil, largely driven by OPEC or Saudi Arabia flooding the market with oil in an attempt to reduce the cost of the oil so they could bankrupt some companies in the US and buy them, essentially. That led to BP suffering badly, firing people and whatnot, and sort of capping opportunities for graduates. And I sort of caught myself thinking, am I a young guy getting into a long career in an industry that might not be here in 20 years' time, especially in the way that it's currently is in an oil and gas environment. So I hedged my bets and I applied to do a master's degree at Cambridge in real estate finance. And that was, to be honest, during my time at UCL even, I had some really great lecturers in real estate and economics and so on who previously taught at Cambridge. I was really good at those classes. I really enjoyed them. They had strongly recommended that I one day do the master's degree, and I thought, great, but I'm going to work at BP, so what do I care? And then, as I mentioned, it sort of led back to that path, and I went for it. I got accepted. I went to Cambridge, had a fantastic time there doing the degree, and just experienced life at Cambridge. It was a great university, thoroughly enjoyed it. And that led me back into sort of a meandered way to real estate, if you like, after having worked in oil and gas and everything. And then I found myself, after doing a short internship at Eastall Secured in the summer, I then joined Thor Equities, which was a real estate private equity shop based here in London.
So your route, your dad was ran the hotel, and you got involved with some building and projects and doing it up and trying to add some value. So that was kind of your window into real estate?
Yeah, I mean, he didn't just run the hotel. It was literally a cowshed, which he converted into a 4-star spa hotel. And me and my brother growing up literally did that with him. Definitely gave us a lifeblood of like bricks and mortar, construction, hands-on kind of work. And my brother followed a very similar career as well, in fact. So that was very much the foundation for us to get into development, I would say.
So that was your route to kind of property, as it were.
For sure, yeah.
And then you thought by going to UCL and doing a bit more of a project management course, you can build on those skills. And that opened your eyes up to real estate being far more than just project management and development.
Absolutely, absolutely. I mean, I was always very normative when I was a child, and university gave me that insight that I could marry together two things, which was like sort of my love or lifeblood for development and construction with financial sort of numeracy side of that work, and real estate finance or the investment side of real estate and buying and selling commercial real estate was quite clearly obviously became a target career path for me and an occupation which I then went on to pursue for various years with different companies before setting up Blue Current.
And so you experienced the consulting piece at EC Harris, come Arcadis, and then BP. And then what did you do at East? Because that was back in 2016. They surely hadn't been over here that long,
yeah,
the UK part of the business.
Correct, yeah, not very long. That was more that a few friends of mine from UCL and Cambridge had gone on to work at these companies and other companies. And prior to joining Cambridge, I reached out and said, look, is there any way I can get some summer internship experience just to cut my teeth a bit, to not necessarily to even lead to a future job opportunity. It was just more experience that might help inform the degree. And it was eye-opening. I mean, it was really high octane, really exciting stuff that they do there. And if anything, it just spurred me on more to want to work in that sort of environment.
Yeah. So graduating Cambridge, that MPhil course, a lot of people have got jobs prior to graduating, and it's quite a competitive course as well, right? And no doubt there's a lot of chat at the pub about who's got what salary, and there's a fair bit of competition. Did you line a job up prior to graduating, or did you do a few milk rounds of interviews, didn't get anything, or what did you do?
No, not at all. When I finished BP, I literally saved up some money during BP and thought, I'm gonna leave when I go to Cambridge. I used all that money to just pay for the Cambridge degree. And I just thought, let's go for it and keep my options open for what to do after Cambridge. I'm sure at that point, yes, it's competitive and everything else, but I wasn't so worried, let's say, about finding a job. I was pretty sure that if I put my mind to it, there would be something out there for me. Eastal, obviously, I did just before, and that could have led to a potential opportunity afterwards. And that was definitely one of the options that I looked into. But Cambridge themselves, it's a fantastic feeder, to be honest. If you're able to get in there and educate there and everything else, getting a job afterwards, they do a good job of making sure that they give you all the opportunities during your time there to get access to potential employers and everything else. So that wasn't so much of a concern.
How did Thor come about?
So Thor came about, I think I actually got introduced to them because, again, a friend of mine had gone on to work there, and I was interviewing at loads of places, and they had an opening, and he said, look, you should definitely think about it, come in for a job interview, meet the team. They were a really, really entrepreneurial, high-octane environment, small team, very close-knit. So I thought definitely, I would never say no to anything. So I jumped in, went down for the interview, went really well, did my financial assessment and everything else, came back in to meet more of the senior members of the team. And they said, look, we need somebody, but we need them now. And at the time, that was, I think, March 2017. Yep. And I didn't finish my degree until July. And I had these ambitions to travel in summer again and have some sort of last gasp experience to just chill out and take some time off before proper work. But I didn't want to miss a chance. I thought it was a really good place, given that I wasn't a spring chicken in some sense. I wasn't 19 years old. I was now 22, maybe 23, having worked already at EC Harris and then BP. And I thought, look, this is exactly what I wanted. It's available now. If it means for the next 3 months, I've got to really knuckle down and study and work at the same time for a few months, so be it. That's totally fine. So I accepted the job, and then I started working 2 days a week at Thor in London, and the rest of the time, obviously studying full time for my dissertation, year-end exams and everything else. So it was pretty intense. Obviously, the studying is hard work. You need to devote yourself to it fully. but also I think I didn't quite expect the level of work or sort of intensity of the work that Thor was doing. So I stretched myself thin, but I look back and I think that was a really good experience for me to really test myself and really force yourself to learn quickly a lot of stuff. And sort of advice I give to anybody who's like just starting out is definitely don't necessarily shoot for a big safe name that has a graduate scheme and you're going to learn things properly and slowly and stuff on. Just chuck yourself in the deep end if you can get access to it, because you benefit from it later on. You know, Thor was very much that there was no hierarchy. It was just like, go for everything you can get your hands on and just work until it's done. And if you didn't know the answer, you don't go home until you do, sort of thing. And, you know, it's a great way. It's just a real life experience of just putting yourself on the front line and doing transactions like with real people, with real money and everything else. So yeah, it was fantastic.
And what kind of kit were you looking at the time?
So at the time, Thor was literally focusing on high street luxury retail-led schemes. So it might well be, they owned Burlington Arcade as a good example.
Yep.
Bond Street House, it's the Patek Philippe building on Bond Street. We looked at lots of those types of things also in Paris and Milan, Madrid, Rome, these kind of key cities with luxury offerings. And it was trying to cherry pick those assets, which are incredibly hard to come by, and revamp them, refurbish them and whatnot, and then sort of sell them on. And it was exciting times. I think they've now pivoted quite well into other areas of other sectors of the real estate industry, so into logistics or life sciences and even data centers and everything else. So good to see them doing well. And they recognize that retail in all respects probably was definitely not the flavor of the month for a lot of occupiers or buyers or anything like this. So they pivoted away from it, but they still do a lot of it.
Yeah, they own a lot of Fifth Avenue, don't they, in New York?
Yeah, exactly.
I think their business is built on luxury retails.
Yeah, exactly. I mean, the CEO, the founder who created the business himself was a very successful owner of retail business before he got into real estate.
So you were there for just shy of 18 months at Thor Equities before you moved. And would you describe them as kind of an operating partner, typically in terms of their business? They might have shifted now to raising dedicated funds, but was that, not typical operating partner structure when you were there? Yeah,
I would call them just a GP, general partner, where they would very much source and originate transactions, get them under offer, get them locked up, and then we'd go out and try and find the capital for a given deal. Obviously, we had framework investors that they worked a lot with on various transactions, but then equally building up new relationships. So they've got a lot of relationships in the US that they brought with them over here to Europe. But yeah, very standard GP LP sort of relationship.
And then you flipped into PSP. Am I right in saying that was an early move from PSP into the UK market as well?
Yeah, PSP, they moved over here in, I think it was May 2017. They opened their headquarters in Victoria, and they were right. They wrote to me on LinkedIn directly and said, look, we've opened our headquarters here, looking to build out the real estate team. We think you'd be a good fit for the team. Do you want to come in, and so on? And I was happy at Thor, I was working hard at Thor and everything else, and then sort of kept getting the emails, kept getting the messages. So I thought I'd give it the time of day. I went down and met the team, and yeah, exceptional place. So I decided to, after a lot of rounds of interviews and very meticulously making sure that I was a good candidate for the team, met everybody before I joined, made the decision to leave Thor and move to PSP. And I think for me, one of the major reasons why I wanted to join PSP was that they were able to give me the ability to look into different asset classes. So like we said, Thor, great in the sense that I cut my teeth for sure in that company. I worked for 18 months, really intense sort of real estate private equity environment in one given asset class, very deep knowledge. And then I took that to PSP, and I was covering from the other side of the table now, rather than an operating partner into a traditional LP, which was one thing. But secondly, now looking at logistics, BTR, office sector, you name it, all sorts of stuff.
So you joined as a senior analyst, so you got kind of a promotion and a move at the same time. Yeah, can you just talk to me a little bit about the 3 years that you had at PSP, kind of deals that you did? I know you went to Australia for 24 hours. Yeah, it's probably, I don't know if I'm exaggerating that, but I definitely know you kind of got off the plane and then very quickly got back on the plane. And you did that multiple times. But yeah, I'd be really interested in kind of, if you can give me a bit of an overview of the types of deals that you're involved with?
Yeah, definitely. So PSP, they partnered with local operators to do transactions, whether that's through joint ventures. Not very often, but they did also do fund investments, putting money into a closed fund. My role, so I joined, I think it was June 2018, and I was assigned to some of our existing portfolios. Interestingly, I thought it might well be UK, maybe European-based stuff, but I was put onto a portfolio that we had in China. Was one of them, two of them, sorry, one of them, three. At a maple tree portfolio over there. There was something with Capital Land and also something with huge portfolios with GLP. So I was focusing on them. And really, for me, that was previously, it was mainly, for example, at Thor, I was doing acquisitions. We were buying things, then passing them over to the asset management team at Thor to deliver the business plan, to get the planning, to do all these sorts of things. At PSP, my role was very much split into sort of, you did both acquisitions and dispositions as well as the asset management for your files. You weren't the GP, but you had to manage those files from both those perspectives. There was heavily doing a lot of asset management work, which I wasn't used to doing, which is great. Again, learning new things and so on. So
holding the operating partners to account, making sure they delivered what they said they'd deliver on time to budget and doing the subsequent reporting, etc.
Exactly that, yeah. And they would often put through like sort of requests for major decision requests to change business plans and so on like this. So it's really crucial that you're heavily involved and you've got a good working relationship with the GP, because we were very active, I must admit, in managing our portfolios, which some LPs, the bigger they are, typically they become quite passive in some respects because the scale is enormous. PSP, what I really liked about them they were large, big investors, lots of capital to deploy, but equally we were nimble in the way that we did our transactions. We knew granular detail about certain things, which made it fulfilling and exciting to understand the assets well that you manage. So what that gave me, again, because of they were a Montreal-based company, they opened headquarters here in London. Everything previously ran from Montreal. They brought the Asia Pacific files to London because it was geographically a bit closer.
Yeah.
And I don't know anybody who was based in London running projects in China or Australia or New Zealand. So that gave me a really cool experience to do all those things. And then a few trips out to China in the first few months to see the assets and meet the partners, and everything else was super exciting. And then the Australia files came over to London and I was put on those. So that was with some really cool, really well-established partners in Australia and New Zealand, like Charter Hall, Goodman Group, AMP Capital. Also a big working relationship with Macquarie or Mira. So that led to then in the subsequent year in 2019, I think I did 52 flights that year. It was like in the whole one a week on average, and they weren't short haul flights. A lot of them were over to Australia, New Zealand, and back to Asia a few times, and always coming across to Canada as well to come back to the mothership, if you like, twice a year to see the broader team. So really exciting. Like couldn't fault it. The travel was great, but the things we were doing, the people that we were interacting with, the quality of our partners, I learned a lot just through listening, just sitting in the right meetings with these very big hitting real estate professionals who you got access to because you're part of an organization that backed them in a meaningful way. So when you go to Australia and you sit down with Goodman Group, you sit down with Greg, or you go to Charter Hall and you're sitting down with David Harrison, like CEOs of these companies. And you're building up personal relationships with them. You're learning from them as the way they conduct themselves, their views and outlooks on real estate, and building that on. So I gained, I guess, at Thor this sort of deep skill set, or this technical skill set. PSP was I became more like a T shape. I like to think, sort of got this deep knowledge from Thor, got the breadth from PSP, whether it's from different sectors and geographies and different types of investments and asset classes, sort of made me into quite early on a bit more of a rounded. I was lucky to have his experiences. Maybe I did sort of create my own luck in the sense I was looking for that indirectly to sort of get those experiences early on. And yeah, I mean, it gave me a lot of breadth of experience, like I said, yeah.
Internally at PSP at that time, because that sounds like a hell of a lot of experience for someone who's relatively junior and early on in their career, albeit you had 2 or 3 years experience in another sector. And surely there's a lot of kind of transferable skills there and interpersonal skills that you could leverage. Who were you working with internally, or were you buddying up with someone internally, or did you literally have you given the trust and you were told to go and deliver, and you kind of had to work it out yourself, or what was that internal reporting?
Yeah, internally
like?
it was a small team, a real estate team at PSP. When I joined, I think there was probably about 9 of us. We had our MD who headed the team, and then there was a couple of senior directors and some managers, and literally I was 2 senior analysts, 2 associates. So the way it worked was typically you'd have a director and an associate or a senior analyst, and then that was it. 2 of you on the deal team, and then you would report into your senior director, and then the 3 of you would assess an opportunity when it came in. You would do all of the legwork, produce the papers, and go over the model and discuss everything with the GP before bringing it to committee to present. And then the 3 of you, once it got approval, you would crack on and actually go ahead and acquire that project. And that would be repeated time after time. I worked very closely with a couple of members of the team to do lots of various things, whether it's acquisitions, dispositions, all the asset management and whatnot. I think the responsibility I had in the asset management side of the tasks I had more responsibility in terms of I was the one doing all of the actual work, and then it would be sent for clearance to the delegated authority member. Acquisition side, it was a huge team effort between a small team, but a huge effort. So I guess that's how we got to, you got this ability to take on more. And if you were willing and able to do more, it was always there for you to do. That definitely, it was, it was sort of encouraged for you to keep going, and to the extent that you want to or you're able to, there's more work for you to do.
PSP don't write small tickets. What tickets do they normally write, and what would you say the typical kind of hold or business plan period? Is it kind of that 3 to 5 year PE value add opportunistic type ticket, or did it vary just given the scale of it?
Yeah, I think they weren't short-minded at all. I think their ticket size was big, so it was normally probably 100 million minimum per ticket, and the business was very focused on the partnerships that you were working with. So it wouldn't be like if a partner came and said, "I've got a great one-off deal, do you want to do it?" It would be less attractive if there wasn't the ability to continue to build out a thematic business plan or portfolio with that partner in that sector, in that geography kind of thing.
Yeah.
So that meant that like maybe they could do smaller tickets if they knew that there would be 10 of those small tickets to aggregate something bigger. Whole period definitely wasn't short. We would happily build to core. Often we would say like, oh, let's do a portfolio to build a BTR portfolio that I set up with in the UK here with a partner called Long Harbour. So they came, we onboarded them as a new partner. We funded the first projects up in Tottenham Hale, and then we did far more with them. And it's gone on now to do, don't know how many, but it's growing massively. And that was very much a 10-year business plan. Let's buy the land, let's build these buildings, let's lease them out, let's refinance them, let's hold them. Let's think about the exit being an IPO or the exit being a portfolio sale. It wasn't a isolated, or let's do an IRR on this one building and try and flip it in 3 years' time when we've PC'd. It was never the case, not short-term PE sort of mindset, which very much was Thor's business plan. Buy it, fix it, sell it. PSP was more buy it, aggregate, scale. Either we hold it or we'll refinance it, or sell it.
So you were at PSP for just over 3 years. What prompted you to leave that business? Because clearly you had an envious job by probably lots of accounts, a hell of a lot of exposure, lots of responsibility. Appreciate the travel novelty probably wore off relatively quickly, but you're at the top table with some seriously impressive people on a global basis. What prompted you to leave that environment where you probably had a lot of trust, there was probably a good plan, you could probably see the MDs and senior people ahead of you earning some serious cash? What prompted you to leave that environment and decide to set up your own business?
Yeah, good question. When you say it like that, I'm kind of worried I made the wrong choice. No, I'm joking. I think COVID had a big role to play in it, if I'm being honest. I had the most amazing time at PSP. Absolutely unbelievable, people amazing and so on. And I think COVID, I moved home to Lake District. I worked from home, sort of back into the house with my mom, my brother, and I think they saw me physically working till whatever time and just devoting my whole life to the job. And they knew I was doing that anyway because I was only taking phone calls early morning or late at night to them and everything. But I think it hit home a bit, and I thought, yeah, maybe there's more to it. Maybe I could look into do something else where I can have a bit of a different work-life balance, if you like. And I think that was a COVID thing. A lot of people reflected on their lives and what to do. But I loved the industry. I loved what we were doing at PSP. And I just felt at that point, now is a good time for me to break away and do something of my own, which was obviously an ambition I had always to do. I think a lot of people say that, a lot of people think that, and I'm not blind to the fact that COVID gave me the additional courage, if you like, to take that plunge. It's not an easy thing to give up on such a good foundation that you've built yourself, a career that you've always wanted to have, and everything else. I had it, and I decided to leave it to go and pursue something on my own. So I think COVID was the catalyst, and also having this exposure to these sort of sectors and people in particular that we're working with at PSP. A lot of that was in logistics. So I said GLP, Goodman Group. I wasn't on the file, but there was a massive relationship with Segro. And it was very obvious, not just from my time at PSP, but very obvious that logistics was the flavor of the month. Before COVID, during COVID, that was just put on rocket fuel, and that was going nowhere. And so I thought, look, keen to do something with my business partner, Max, who I had met at Thor.
So you worked with him at Thor. He was another analyst, kind of same time that you were.
Yeah, exactly. I think I don't want to jump around, but that's how Max and I met. We met when I joined Thor. He was already there. We became really close friends, probably from working super late together every night and helping fix each other's problems in our deals. We became really close. I left PSP. He stayed on, and from then on we were just best mates. And he was in a similar position actually in COVID. He'd left Thor. He was working with a family office, and he sort of said, "Look, I'm thinking about maybe like getting our heads together and doing something." And I said, "You know what? Ironically, I've been thinking the same." So that's how the birth child started. And then I said, "Look, what I've been doing at PSP, and this is my opinion of what I've been learning from all these people and his experiences." And he sort of complemented that with we're very different people, I must admit, Max and I. And we do complement each other massively well. We bring things differently to the table, and I think that helped. We spent lots of time. I hadn't yet left PSP. I'm talking now, when we sort of got together, it was on his terrace at Notting Hill. We were having a barbecue in like April 2020 or something, middle of COVID.
In lockdown, when you in lockdown, when you could see like one friend, have a bubble and go and see them outside.
Yeah, I actually think this is when you weren't even allowed to do that. So maybe it's a bit naughty, but we had this idea, and we sat there and we thought, let's do it. So really like pumped to get started. And then I didn't leave PSP for another year. And I said, look, let's, in the background, keep thinking about what to do all the way through the rest of 2020. And then got to 21 and we were like, let's do this. And Max had started full-time devoting his time into Blue Current Capital, which at the time was called Black Botch. So
Black Botch.
Black Botch, yeah. It was
because his surname is
Botschen. Yeah. So we said, look, we need a name. Let's just give some name. So mine was Blackburn, Botschen, Black Botch. Thought it was really cool actually, and we still have it set up. But we had Black Botch going, and at that time we were looking into many things to do. We were saying, look, ULEZ zone was going to grow. We thought, look, something creative to do down in this space. There was an idea to try and buy car parks just on the inside of the North-South Circular, which we believed would become redundant or far less usage on them, because people would no longer be just driving over the North-South Circular to park their car when they've got to pay £12.50 a day to do so. So we thought, great, let's buy these car parks. When the ULEZ zone grows, we've got a strong claim to the council to say, look, give us change of use to residential, because your mandates have made our business irrelevant.
Yeah. And
then flip that to a developer or something like this. So we had this idea. We looked into lots of opportunities, trying to dig away with our network and find car parks. We actually came across a quasi car parking opportunity in Stratford. Somebody we knew, ex-Thor colleague or relation of Thor, and said, look, we heard you wanted to try and buy some car parks. We've got a great one in Stratford. It's not actually a car park, but it's going to become one. I said, oh, well, that's not what we want to do. But anyway, you're on the phone, so what is it? And they said, yeah, it's an EV charging hub. It's going to be an electric vehicle charging hub for commercial vans. And just thought, that doesn't make any sense. I don't even know what you're saying. Anyway, it sounded exciting, so we looked into it. And then it ended up we really, really tried hard to buy this thing with this sort of AFL, if you like, or this agreement to then go on to build out an electric vehicle charging hub. And it didn't go ahead because the occupier had said, look, the site's too small. Actually, we need more space to park vans. And that sort of blew our mind. And it sort of brought everything, like light bulb moment for us, if you like, brought everything into perspective in the sense of, hold on, we've always been like doing lots of work into like parking and vehicles, storage and everything else, and the right locations. And we always had this love for logistics and recognition that there's the tailwinds behind the movement towards becoming net zero were going nowhere. And it was more than just greenwashing now. It was becoming a very relevant and actually super important concept of real estate. And then there we had it fall right in front of us, if you like, this sort of proof that this need for storage of vans and especially electric vans was real. So we took that away and we thought, what just happened? Like, what does it even mean? What does it make sense? Let's make sense of it. So we did lots of work and recognized that, people talk about warehousing and logistics space, and there's a massive supply, demand, and balance of it. It's still huge demand for warehousing, and there's just nowhere near enough of warehousing. And a warehouse means a shed with a yard, 55% site coverage, a big shed, big yard. And that yard is for HGVs to come in, turn around, leave, maybe have some trailer parks in there, some open storage in the summer. But most of these warehouses are occupied by parcel delivery companies, the last mile anyway, 3PL companies or online retailers. These people have massive fleets, huge fleets that take those bulk goods dropped off during the night with the wagon, take them to the customer's door in a van. Those vans are diesel. And whether they like it or not, you're having to transition away from diesel into a decarbonized vehicle, which is quite frankly just electric, the only option that's viable at this stage. And that's driven by UK regulation in 2030. There's from that point onwards, you cannot buy a brand new diesel or petrol powered vehicle in this country. And that's only 7 years away. And even that aside, a lot of these blue chip 3PL companies have got corporate social responsibility. They're pledging to do the right thing sooner, way before that regulatory cutoff. And thirdly, it actually makes sense. It makes financial sense now to transition because it's cheaper. Cost of filling a vehicle per day is, what is it now? Nearly £2 a litre still. So you're talking like you're doing a fair amount of miles a day. It can be £50 a day to fuel the vehicle versus if you charge in that van during a night time on a 7 kilowatt charger, it can be £7, £8.
That's on a 25 litre tank. I mean, surely these tanks are 100 litres, 200 quid plus.
Yeah. I mean, it's astronomical. I mean, it just makes commercial sense as well. So with that in mind, I think the problem for these occupiers is not getting the vehicles. They can buy the vehicles, they can lease the vehicles from anybody. Mercedes are churning them out, Ford, you name it. The problem that they've got is very much that they don't have the on-site space required to retrospectively charge all of these vehicles. They only have the yard, which they need for its various uses that they've always had to have it. They can't rely on public infrastructure because it's not designed for vans. It's designed for private individuals with cars, the lamppost chargers and so on. And they don't have, even if they had the space on site, they haven't got the cash to develop out a charging facility. They're operationally driven companies. They don't have capital to deploy. And again, the concept of getting the power connection to a site, like, good luck. Like, it's extremely difficult. In London in particular, like West London is zero. And in other areas, if you want it, you can probably get it. You wait for it. And the UKPN or whoever the relevant DNO is, they'll give you the point of connection, but it might well be 3 kilometers away. And you have to dig up an A road in London, 3 kilometers, to lay the cable to bring it to your site. So it's difficult. It's very difficult for them. And they need a private charging facility. If they don't have it, they're operationally, those vehicles, there's a big risk that they won't be fully charged. They will run out of charge. They won't be able to deliver their parcels and so on. So the problem that they're having is that they can't transition quick enough because they don't have the ecosystem to charge and ensure their ability to charge these vans. That's what our whole mission statement is to sort of help them accelerate and enable them to transition.
Remove that bottleneck for them.
Exactly. And our product, it's very similar to I know you had Phil Bayliss on the podcast last year with Infinium Logistics. Part of what they do is obviously very correlated with what we do, in that what we do is we're building EV charging hubs for commercial fleets in close proximity to where they operate. so right next door to their warehouses. Infineum are doing a very similar product. And we to date we bought 2 sites in our first year. So we formally set up, as I mentioned, I think I finished PSP in August 21. Max and I sat down in Munich together, day one, his house, and said, right, let's go. Bought some laptops, put an Excel tracker together of all the phone numbers of all the people we thought might be relevant, and just started ringing them all and saying, do you want to get coffee, catch up? I've left PSP, I'm doing this. I'm sure you can help out. I'm sure I can help you. Let's go.
So you'd kind of worked out what you were targeting, what you're looking for. You kind of identified that bottleneck, and that's what you pinned your business on.
Exactly, yeah, exactly. And it's very simple. I mean, what we're doing is something extremely focused in that we are buying land, commercial land, employment use land in these existing clusters of gateway cities in the UK. So we started in London. We're based in London, biggest city, biggest demand and everything else. And we target locations like Enfield, which is the premier last mile cluster of London, North London. We bought a site there recently in October for exactly our use. We bought a site in Belvedere, which is the southeast London last mile cluster. Again, in that void between the M25 and the North-South Circular, where the majority of the last mile clusters are. You can look at London almost like a clock. Like you have Enfield, you've got Barking area, Dagenham, you've got Belvedere, Croydon, all the way around to Hayes, you name it. We're looking at all these locations. And the ambition is very much we buy these pieces of land anywhere from sort of 2 acres all the way up to 5, 7 acres. And we build out more often than not a multi-story EV charging hub to store anywhere from sort of 500 plus LCVs, or light commercial vans. Each bay would have a designated charger in it. That would typically be a slow charger, so that those vans during the daytime, they're off doing their job, dropping parcels off. At night time, they come back, the driver plugs it into charge and will leave the hub.
Like a 22 volt.
It's 7 kilowatt.
It's 7 kilowatt.
Yeah, 7 kilowatt. And the benefit for the occupier, I guess, is that they, during that period of time, so at the end of the shift, let's say 8 p.m., the van's left, the last van gets dropped in the hub, and then they leave. That 12-hour window of time in the night time from 7 p.m. to 7 a.m. is the nighttime tariff. So the actual cost of power usage in that time is cheaper because everybody is asleep and nobody's using the grid, less strain on the grid, so cheaper per kilowatt. So it's also a great way in the sense of saving money that the vehicle will charge and not put any strain on the grid because it's charging when the grid's not in use. And we're big believers in what we're doing, humongous believers in it. And we envisage having, a Blue Current hub or EV charging hub in one of them in every single major industrial cluster of the UK, from London to Manchester, Birmingham, Edinburgh, you name it. And what we're seeing is some occupiers are putting charging into their existing facilities, but you can only put a handful in, 2 to 10 maybe. And that's great. It's a bit of a greenwash in some sense that it helps, but it doesn't touch the sides in terms of fulfilling the entire fleet to decarbonize. And existing landlords are a bit reluctant, if not entirely reluctant, to retrospectively build out sheds with charging hubs, because at that point they're hamstrung in the sense that, great, if a DHL or a DPD or somebody takes a lease in it, fantastic. The warehouse and the charging hub, they're leased to a DPD. If DPD leave, a Netflix show up and say, hey, I'll lease the warehouse, but I don't want the hub. They've curtailed their leasing ability, because not all warehouses are leased to parcel delivery companies. So you can't go around just building hubs with sheds all the time, because not every shed needs the hub. You see what I mean?
So you and Max in his flat in Germany. He's from Germany, isn't he?
He's from Munich.
Yeah. You're not just in a random flat over there. Bought a couple of laptops, chucked a bit of money, some savings into a shared bank account, put up your Excel spreadsheet and start calling through people. It was one of the first calls, like, how are we going to finance this? Or do you find the deal first? Is it the chicken or the egg? How do you go about doing that?
Yeah, exactly. So I think to Munich, we actually went there. His family home is there. We sort of went there offsite day one, came back, and we worked from Max's kitchen in his house in Notting Hill for basically felt like forever, good 18 months. And that's exactly right. Day one was, okay, let's get our mission statement together. Let's get our sort of narrative as to what we're trying to achieve out there, and pick up the phone to a lot of the investors that we've got to know for our careers before we found opportunities. and just warm them up to the idea. And we met with many a person, from anything from funds to high net worths, family offices, all spectrums of the capital stack. And everybody expressed huge support for it. They understood it. There's crazy tailwinds behind it. They all got it. A lot of people thought, look, great, come back to me when you've proven the concept a bit, because it sounds great and everything else. It is fantastic, but there are obvious roadblocks to it that other sectors of real estate don't have. For example, you need a lot of power. You need to potentially pioneer a new planning asset class, or you need to change use sometimes to sui generis. So what we did was we had a handful of trusted high net worth investors and family offices that we got to know extremely well from our careers or through other networks. And we, together with them, have funded our first 2 transactions. And we're now under offer on 2 other transactions also here in, just London and just outside of London. And that's something that early on we made the decision to stick with. We're playing the long game here. Blue Current Capital, we want it to be around forever. We want to grow the business organically. And that is from anything from the office and the staff headcount all the way through to the capital that supports us. So we've got, at the moment, some really innovative, really supportive backers who funded the first 2 deals. And those 2 deals are effectively our chances to prove the concept. So we're using them, we bought them, fantastic sites in Enfield and Belvedere, put the planning in, pre-apps, we're getting that back this month. And we've gone out to speak to all the various occupiers on it and everything else. And I think on the back of that, to the extent possible, we want to continue to work with these families, but we equally at one point might have a disconnect in the sense of we want to scale, and organically we're scaling. 2023, here we are now in January. By the end of this year, we want to do 5+ deals, 5 to 10 deals. And to the extent that they can continue to support us, absolutely, we will do it with them. But equally, we are cognizant of the fact that our organic growth will kick in at one point in this year. And we're minded to now start to reignite those discussions with the institutional capital providers. And at the same time, we're proving their concept more. So we're probably more now aligned in terms of working together. We've gone off, we've proven our ability to originate transactions, to close transactions, to raise financing, raise debt, do the planning. And we want to continue to do that and scale it out quickly. So that's where we are with capital.
Talk to me about the first couple of deals. How did they come about?
Yeah, so the first 2, we introduced them through the agency network. We know all of the right people. We got the phone call. The first one was Belvedere, Southeast London. It was a sale and lease back to a Turkish haulage company. Great little site with about 2 years of lease income on it. So we thought, perfect. It's going to take us a couple of years to get the power and the planning. It's pin in the map in a fantastic location for us. We love that area, right in the heart of the cluster. All the big operators that we want to be targeting are located there. So we put a bid in, shortlisted right through to the second round with Segro. So Segro had put a massive, not long prior to the opportunity, I think 3 months prior, they bought 20 acres of land in the submarket. Literally, we didn't even realize at the time, but literally bordering the site. And great, we thought we're against Segro. That's totally fine. Expected it. We're gonna have to lock horns with these kind of characters at some point. So we pushed hard. We won the process, not by like big numbers. It's quite incredible, in fact, that they selected us. We thought even if there was a couple £100,000 delta in our bids, if I was selling, I probably would have still gone with the Segro.
Because they own everything apart from this one small part, right? So
yeah,
it's like the final key or piece of the jigsaw for them to unlock a big scheme.
Yeah, exactly. And they're the world's largest REIT. Very credible execution. Risk would be nil with them. We were new kids on the block, but we were paying a higher price. So we went on. We got it locked up. We did the DD, raised some debt, bought the property, and then we got a phone call from an agent who represented Segro saying, "Who are you guys? You turned up. You've spoiled our lunch." I said, "Oh wow, didn't realize." And then we did try to buy the site next door, which came up online very shortly after. I think Segro set a record price the period before when they bought the 20 acres. We came in, we bought for a fair price, high price. The guy next door came on and we thought, perfect, we can quickly buy that and amalgamate a really good ownership down here, which is only going to strengthen our case. Segro also showed up again, it boarded their site and everything else. And this time around, they weren't playing games, so they blew us out the water. But it was such a fun experience to think, 6 months prior, I was working at PSP. We have partnerships with Segro and these kind of companies. And then here we were outbidding them, beating them on transactions that, if someone had just said, do you think you'll beat Segro or something like this, or you think you'll ever compete with them? And I would have thought like, oh, it's nice to think I'm able to do those kind of things, but it's amazing what you can achieve. It's just, that's the whole beauty of sort of going it alone and just putting your best foot forward and everything else. There's so many inefficiencies that you can take advantage of by being small and nimble, that bigger corporations, just from sheer size and bureaucracy and everything else, aren't necessarily able to be that agile. And that's proven really valuable to us. That was obviously how we were able to even get Belvedere. We could move, on a 6 months. Whenever we were asked to do anything, we could make the decision there and then go for it straight away. So that was super exciting, really amazing. And then on the back of that, we got a lot more interest from the agency market and what we were doing. Our whole business plan started to make sense to people. And I thought, wow, you guys are like new kids in the block. You got a really cool business plan that enables you to compete with these people. So yeah, exactly. We want to keep going. We want to scale. We want to get the right kind of sites, and that got us off-market opportunities. Again, a very similar situation in our second one in Enfield was a sale and lease back to a private individual selling their site. It was a scaffolding yard, and the person selling, they just rang up their broker in Enfield. It was a very well-known broker who'd been around Enfield for decades. Not a big shop, just sort of a one-man band style. And again, Segro were around. They'd owned some land nearby and everything else. And I don't know exactly how it happened, but we got the phone call via one of our agents, said, look, I've got you a really good chance, really good odds of buying something in Enfield off market. Nobody knows about it. I thought, well, yeah, great. That sounds amazing. And that was really, again, only on the back of being, doing what we said we would do, executing on Belvedere quickly, being agile, being really, having conviction in what we're trying to do, and just proving, like giving the era of confidence to the agents. Agents are very much the blood life of the industry. They find the deals, they decide who to pass them to and everything else. So we're really focusing on treating these guys very well. So far we've had the best sort of experience with everybody we've worked with. They've been great for us, and that's allowed us to get deals that aren't marketed. And that in our first year to do our second deal truly off market is something that's, that as itself as a value add proposition to any investor is incredible, to be able to get access. That's sort of a reason why somebody should look into doing things with us, is because we genuinely can add alpha in that sense of, because we have these strong relationships, because we're on the ground every day, we can dig things up that there's no brochure, there's no material. It's just, would you be keen or not? Do you want to come tomorrow and meet the owner on site? Yes, fine, great. Let's sign this piece of paper. Okay, you got 4 weeks. Go away and do your DD. So yeah, it's been fantastic.
So you're not still in Notting Hill in Max's kitchen. Where's the business now? And yeah, what are your kind of plans for 2023?
Yeah, exactly. We moved out of the kitchen. I think it was November last year. So we opened up the office on Golden Square in Soho just before the break of the year. Great move. Fantastic to have our own space. We've got like a 3-4 person desk office at the moment, but the ability to grow into the room next door as well. And that was pretty much exactly where we wanted to be at the end of our first year. Sort of some transactions under the belt, some planning permissions gone in, open up the office, and then create a roadmap for the growth in 2023. This year, ambition is very much to grow the business in terms of headcount. And that's concurrent with growing the business in terms of assets under management as well. So we have the 2 deals, most likely to have 3 and number 4 before the end of the quarter, definitely needing headcount. So I think we're in the market, and we'll be picking up the phone to yourself very soon, no doubt, to discuss possibility of looking to get various roles, in particular somebody with an asset management, development management capability skill set, and also support on the transaction side. Analytical role, a relatively junior role, potentially sort of graduate level, to support on the underwriting and the creation of the teasers and the memos and so on that we present to the investors. Ideally, want to be to, again, in this whole concept of growing organically and being a relatively frugal business at the start. All of the money that's funded the business has been personal savings from Max and I. We've thrown the kitchen sink at it, quite frankly. So I think we want to grow to, let's say, 5 people by the end of this year, 6 to 7 transactions under the belt, and take it from there.
It's an incredibly exciting time. And like you said, there's a lot of tailwinds behind this particular sector. You touched on Infinium earlier, and there's a few other businesses, am I right, sniffing out deals in this type of space. I think you mentioned earlier off microphone that initially, you kind of came to this realization without realizing anyone else was in the space as well. But the fact that other people are playing in it has given you further conviction that what you're doing is the right thing.
Yeah, definitely. I think like Infinium are a very correlated company to us, doing the same thing. There's definitely other people out there doing EV charging for commercial fleets in different ways. And we're very cognizant of the fact that charging of electric vans isn't just going to be in a blue current hub. It's an ecosystem of charging. There will be people on rapid chargers, on driveways, in depots, and so on. When we came across other people doing it, it definitely gives us just added conviction in what we're trying to do, and also confirmation that we're not crazy, that other people are also seeing what we're seeing and recognizing that this is a genuine asset class in its own right, and it will become one. And whether or not everybody sees that today, every day that goes by, we get closer and closer towards 2030. And if you fast forward to a position in 2029, let's say, and you're a fleet operator in a last mile and you've got diesel vans, what will you do? Like, you have to transition. You can't go on to own new vehicles that are not diesel. So at that point, it's too late. We're getting ready for that window, for the handful of years to come before it becomes extremely relevant that this asset class and this sector makes complete sense. So the fact that other people are doing it is music to our ears. We consider them very much as peers with us, first movers in what we're trying to create here. I think if you think of like threats or competitors to what we're doing, our initial outlook was people like Segro or people like Goodman Group. I mentioned that I used to meet often with Greg Goodman himself in Australia. He's a very innovative guy. He has done many an EV charging hub for Amazons of the world and so on already, albeit opportunity-led, where they've probably asked him, hey, can you build me something? The answer is always going to be yes, but doing that on a more of a build it and they'll come basis, they probably haven't got to that place yet. But that's because there's just so much low-hanging fruit for these guys to continue doing sheds very well. But they'll pivot, no doubt, and start to do EV charging. And again, at that point, we want to make sure that we're ahead of these companies because they've got the relationships, they've got the land, they've got the skill sets and everything else. But one thing that I think the first movers in this space have got the advantage of, so that's ourselves and Finium and potentially some others, is that it's hard to buy logistics land in areas like London. It's very hard. We've managed to do it twice, and it's not been easy. It's not a walk in the park. But what's also equally hard is getting power. And I don't think anybody's really thought of that yet, that the price of a 2-acre site in Enfield for logistics is, £10 million an acre, let's say. If you have that site and it has a 5 or 3 MVA connection to it on the doorstep of that site, that's worth a lot more than the neighboring site, which is the same size but without the power. And we have on both of our sites been able to get those power connections to the sites already, and it can be very costly. Enfield, we managed to get it relatively efficiently, and it's made that business plan now so strong in the sense that we own the land, we have this fixed connection of 3 MVA on the doorstep of the site, and it enables you to do things that even if somebody else wanted to try and build a charging hub in Enfield, they don't have the power. So it's extremely hard to replicate.
So can you, because of what you're doing and your knowledge, you can write sharper prices than maybe what other traditional shed developers would?
I think in some respects you can. Whether you would need to, though, I don't think so, especially in the way the market is right now and it's softened. If you have additional ways, if you think you have a higher and better use of that land than as just a shed, it enables you to be able to effectively pay more for it. And Q1 last year, we were having to make use of that knowledge a little bit to sharpen our pencil to make sure we could beat these logistics operators. Today's world is very different because it's a far softer market. You can't get the financing to support transaction purchases, question mark where the yields are going to go and everything else. So pricing is already softer. So for someone like us, and our in-house view is we think long-term, we think great, it's turbulent at the moment, but if we stick to our conviction of what we think we're doing and we believe in it, and it's recession-proof to some extent, you can't slow down the need to hit net zero. That means you need to decarbonize transportation. That means you need charging facilities. So, and they need to be in the right location. So we continue to buy the land. And if you can buy it at a discount to where it was, there's no need to flex these muscles around. Oh, we could in theory pay more because we have the power. Keep that up the sleeve and actually try to buy it at the best basis possible, just because the competition has narrowed out.
What's been your biggest learning since setting Blue Current Capital up?
Biggest learning has definitely been how real estate is a very people-driven sector and industry, in the sense that it's important to make sure that your personal brand is strong and that you have a good hold of the market and the right people in the right places and so on, because opportunities that have came to us have largely been through our networks, and more often than not, a casual coffee with somebody has led to something material, or the most sort of off-the-cuff conversation that has just snowballed into something real. And working at companies like PSP and Thor, when you're an employee, you don't recognize that, or you're not in those environments where that is a realistic thing for you, because you have your role to play, you have your position at the company. And that's something that I didn't expect, to be honest with you. I thought it would be a bit less inefficient. We've been able to really, if you want something, you can definitely speak to people and try to get hold of it. So it's been a real eye-opener, and it's been really sort of fun, to be honest, more than anything.
You mentioned you've got aspirations to grow headcount this year. For someone who's listening to this podcast who is captivated by what you and Max are doing and wants to be part of the journey, what are the traits, values, qualities that you look for when hiring, or the people that are around you that they need to possess?
I think we're very cultural driven, in the sense that we want to make sure that the team gets on as a friendly and family sort of environment, more so than anything. I think that for us is like collaboration is very key. We want people to join who feel at home and are comfortable enough to challenge things and express themselves and bring something to the table. I think I mentioned it earlier that Max and I are different personalities, and that's been hugely beneficial. We challenge each other constantly on everything, almost, probably more me than him. I'm sure he's sick of it, but that's productive, and it's enjoyable. And people who are, obviously have a want to learn detail and work hard and build technical skill sets, but equally somebody who is passionate about what we're trying to do. We're a real estate company. We have fiduciary duty to our investors to make them a financial return, full stop. That's our job. But that isn't to say that we're doing things to compromise our overall ambition, which is we're trying to, and not to sound cheesy, but we are trying to actually stop the temperature rising. Like, we want to leave the world in a better place, and I'm sure everybody does, but it's nice to know that what we're doing actually correlates strongly to that, in the sense that we're taking every van facility we build and stores a vehicle in it is another diesel vehicle off the road, which is fewer emissions, which is less strain on the climate, and so on. So that's always crucial and key, to never forget those sort of that core principle of it. And I do feel that this generation coming through now is far more aware of those things than you or I were, or the generations prior to us were as well.
So as we draw to a close here, Nick, I know that you've got some very strong financial backers, and you do have an ability to raise capital or a fund if you do want to, although you're not choosing to do so at the moment. But if I was to give you £500 million worth of equity, who are the people, what property, and which place would you look to deploy that cash?
500 mil, I think I have some personal sort of people who I admire big time in the real estate world and everything else, and not even real estate, but just general investment environment. And they've all got like quite a common theme of being black sheep in some sense, like going against the grain and doing things. I guess what I'm trying to say is I like people and believe in people who stick to their convictions even when times get bad. So people like Ray Dalio, obviously huge, big heavyweight who's well known for that kind of stuff. Equally like Howard Marks and so on. These people who who, unlike the common herd of everybody, to be honest with you, we all get nervous when you see that there's a recession looming or interest rates going up. It's your human instinct to sort of tighten up and question everything you do. But if you don't forget the fundamentals and you just can't continue doing what you expected, what you were doing, and just forget that short-term sort of news, if you like, then you can do exceptionally well. And you don't have to be really smart or really anything. You just need to be quite bullish or have thick skin to walk through that period. And they've both done that, numerous times in the GFC. I think they both did incredibly well. And that, for me, reading about that and learning from that is something that I would love to say that one day, I can say, yeah, I had that. I took learnings from them as experienced investors and what they did with Oaktree, Bridgewater and so on, and took those learnings. And, not to sound cliche, but like, again, the likes of Blackstone, even like reading React News just before Christmas, they were dropping £300 million on logistics in Manchester and so on, picking things up, even at whatever discount it was to prior months. That's a fantastic outcome. And I think those are the types of people I would give that would support with that money. And the sectors, I wouldn't deviate from the sectors that we've all been interested in for the last 2 years. So it's predominantly logistics, predominantly residential, these very sort of protected in asset classes that have got fundamental tailwinds. Logistics, that's pricing has came off a bit now. It's interesting. It'll be very interesting, I think, to see what happens in Q1 this year when all of the larger organizations have to file for their annual accounts and get their assets marked to market. And those red book valuations will no doubt on paper show some losses, big losses. And that can lead to REITs dropping in valuations and so on. And that's just a buying frenzy. If you've got the backbone and the stamina to just buy through that window, inflation one day soon will come under control. And when that happens, interest rates will come down again. And, before we know it, debt's available, yields come back into line and so on. So it's nothing special. I think it's just doing what everybody was doing, but just backing the few people that have the ability to keep seeing it through even when times are tough.
Amazing. Well, look, thank you so much for joining me today. Excited to see what you and Max go on to achieve. And no doubt everybody listening to this is thoroughly inspired by your mission and what you're trying to do.
Thank you very much. Thanks for having me.
Thanks. Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague, subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of which guests you think we should get on the podcast or areas of the market that we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockbourne. The team recruit experienced talent for real estate private equity firms, investment managers, REITs, property companies and advisory firms across the investment, asset management, development, fund management, ESG, cap markets, investor relations and general practice space. So if you're considering your career options at the moment or looking to attract top talent to come and work for you, head over to the website www.rockbourne.com where you can find a wealth of resource to aid your search. Have a great day wherever you are and I look forward to catching you next time.